Welcome to the Beautiful Brand Podcast, where we explore how you can use your intellectual property to protect and grow your fashion or beauty brand and business. Join us weekly for guidance, encouragement, and inspiration to help you launch, protect, and grow to profits your fashion or beauty brands. Your host is Jessica Eves Matthews, a 26-year intellectual property and business attorney and fashion and beauty entrepreneur. Every week, Jessica shares insider wisdom, tips, and easy to understand guidance on how you can get your fashion or beauty business off the ground and growing in no time.
Sounds good.
Hi, everybody. Welcome. It's Jessica Eves Matthews. I'm super happy to have you join me back for my podcast. And today I have a wonderful guest, somebody that I have a lot of respect for, and sort of a newer colleague and friend, but I just think what she's doing in the world is amazing and so needed for entrepreneurs and business owners. And I think it's an area that gets overlooked because I think it can be intimidating for people. So we have Natalie Cook with us. Natalie, she is the CEO of Copper8 Strategies, and she's also the creator of the Finance Fight Club blog. She describes herself as a business super nerd, and she spends all her spare time thinking about financial strategy. You sound like me. I spend all my time thinking about intellectual property. But Natalie is passionate about enabling business owners to take control of their business finances, which is so important. And I think it's something people avoid for as long as they possibly can, often when they launch. Natalie has an MBA that she earned while working a full-time job, pregnant with her first child, and in the last year holding that child while she finished her degree, which is incredible. And she worked in corporate finance at Starbucks and in philanthropic investing prior to founding Copper8 Strategies. Copper. See, yeah, because your name is Cook, then I was like, I keep getting confused. I want to say Cooper. Copper8 Strategies.
I didn't think about that with the cook and the
I wondered when I looked at your name before, I was like, wait, no, that's not the same. Stop. Like, it's Cooper. No, Copper. So anyways, no one will forget it now. Copper8 Strategies. And Natalie has traveled the world and currently lives in the Pacific Northwest with her husband, 2 kids, 5 chickens, and 1 puppy. And I just learned they just moved to a new property with acreage, and so you have room for your whole clan to spread out, which is amazing. So I'm just super happy to have you here, Natalie. You and I've had some really stimulating, interesting conversations, and I feel like what we both do is something that intimidates people often when they're founding a company or a business, but they're 2 of the most important things to address and deal with. And so I'm super happy to have you here. Thank you for giving us some of your time and your expertise today.
Yeah, thanks so much for having me. I love doing these things, and I'm just excited to talk to you. So
I'm excited to talk to you too. Well, first of all, before we jump into, we've got some really good stuff to talk about today. But before we jump in, can you just tell people what Copper8 Strategies does?
Yeah, so Copper8 Strategies is a financial services firm. We focus on CFO, so fractional CFO support for businesses that are scaling or thinking of selling in the next 5 years. And then we also provide advisory services and project-based services for other businesses that might need some back-end financial support.
Okay, awesome. So can you explain to people what a fractional CFO is?
Yeah, so businesses need a CFO, so Chief Financial Officer, and we have made it you don't need a full-time one. Typically, businesses don't need one until they're 25, 30, 50 million in annual revenue. It's just too expensive, not worth the cost of hiring. And so we've made it you get a fraction of us. But a CFO, for those that are unfamiliar with the finance terms, we're a forward-looking strategy person. We're the right hand of the CEO. We help make strategic financial decisions using the backwards-looking data that your accountant or controller would put together.
Awesome. That is super interesting. And I'm going to follow up on that as we start digging into some of the questions. I always think when I hear about these fractional positions that have really come about in recent years, which I think is brilliant, it reminds me of a timeshare, like for people to sort of conceptualize it. And so you're not having to pay for the whole piece of property, but you do get the benefit of it, for a portion of the year. So I feel like that's what this is, but in services form. So I think it's really brilliant. And I know more lawyers are starting to sort of package themselves that way as well, which I think is super creative. It seems to be like a very perfect fit for companies that are emerging and growing, working on scale, but don't quite need the full-time employee yet for those activities.
Yeah, I like to say every business needs a financial strategist. It's just depends on what size you are to what level of financial strategy you might need.
And this is different than just in case people have these questions, it's different than having like a CPA.
Right.
So can you explain to people why, like, obviously having a CPA and a bookkeeper, all of that's important as well, but what do you do that's different than what a CPA would do?
Yeah. So a CPA, and it gets so confusing because there are CPAs that do CFO support and bookkeeping and all that, but the actual role of a CPA is to file your taxes and provide some tax strategies. So they're trying to help you save money on taxes. It's not that I don't care about saving money on taxes, but my view is the whole forward looking. So I'm helping you think through how to increase your revenue, how to make sure all your expenses are driving revenue and being optimized, cutting expenses that are unnecessary, getting really in the weeds in your gross margin and what's working, like for a product, how are you going to source all of that, and really thinking through all of those decisions. A CPA only cares about maybe your quarterly or annual P&L and how to file those taxes. And then a bookkeeper is putting all the things in the right spot.
Right. They're just sort of data entry and categorizing. And so they're all important, but what you do, I think is something that gets very overlooked, unless you're like in an accelerator or incubator program and you've got advisors who are making you think about these things from the start and you're having to put together a business plan and a pitch. This stuff I think tends to get overlooked. And do you find that you have to go in often after the fact and sort of clean up messes and identify money leaks and areas of financial risk?
Yes, that's most of what I do. Do a lot of forecasting, cash flow forecasting, and a lot of like the oversight of how do we build the process so that things don't happen. So when you get to a certain point in your business, you need like an expense policy. Well, HR does the expense policy from the HR risk, but it will help think through it from the process risk. How are you capturing all those dollars back?
Right.
And those are just things that we're constantly looking at. In terms of cleanup, I've helped at least 4 or 5 companies in the last year get new bookkeepers and getting onboarded and saying like, actually, the way that you're doing all your bookkeeping is not working. So we need to get to a better system. And that's where that overlap gets really confusing because I don't actually do the bookkeeping, but I have to know enough.
Yeah, the data has to be there. Right, exactly.
Yeah.
So that's important, everybody. Make sure you have someone who's entering the data, but then you definitely need someone. So it's sort of the difference between being in the weeds and then the 30,000-foot level, which is what you're doing.
Exactly. And the other thing I'll add too, because I think this gets really confusing for people, is even if you're entering all of the data and it's all correct, there's different levels of complexity when you get to a certain point in your business where a bookkeeper may not notice. So one example is when you need to switch from like cash basis accounting to accrual basis, which I don't want to get technical in that, but when you reach a certain point, it's not a good idea to continue to do cash basis accounting. And a CFO is going to help you make that decision.
Why is that? Because I think that might be something people are curious about. Cash basis obviously is as you receive the payment, you book it. Accrual is it's on the books, but you haven't necessarily collected, right?
Yes, exactly. So the biggest, for one really good example is, so product-based businesses, when you are on an accrual method, you are tying you're tying the cost of that sale to when the product is sold. So you're not saying, oh, I bought $1 million of inventory, so I spent all of those costs of goods in October. If you are cash basis, you would just put that in October on your P&L. And then you would have like $0 in December. So your gross margin would be like 100%, huge, and then it'd be negative. So the accrual method allows you to pull down those costs as you sell product. So it matches the expense with the time of the sale. And it just makes your books look clean. You can actually analyze the data.
Right. It actually gives you a better picture of what's happening all year in your business. And that's helpful. So one question I think that I'm curious about is what one piece of advice, or maybe a couple pieces of advice, would you give a founder or a business owner on how to set things up when they're starting to make
Yeah.
sure that their financials are properly managed and tracked? Because I think that's something, again, that gets overlooked. It's very similar to the IP side of what I do. What advice would you give someone if they're listening and they're literally just starting, but their
Yeah.
plan is to grow, right? They want to build something big, but they're
Yeah.
not
I
there
think
yet.
there's two pieces. One is no matter what you do now in 18 months or 2 years or at another 500,000 in revenue, things are going to break down. So just know that's going to happen. So don't try to make it.
Hmm.
So you don't need to have the system that $1 million company has when you're making six figures. You just don't.
That's awesome.
It's
Yeah.
okay to wait for those things to come up. And then the second one would be, if you're the tactical piece is do the work to make sure everything is categorized correctly. You can fix it later, but if you never put the data in there, then it doesn't exist. And
Right.
it's going to come back to bite you. File your taxes, organize your books, even if it's a little bit wrong, just do it.
Right. And that way, at least you got a start and it can be fixed and revised and tweaked.
Yeah.
From the KPI perspective, so KPIs are something that not everybody understands what they are, especially when they're first launching. So can you explain what they are? And then, when you're launching, like what are the sort of the key KPIs that you think people should be tracking from the beginning?
Yeah. So KPI for people that aren't familiar with the term is key performance indicator. When you're first starting, you really have to look at what does success look like for you in the next 6 to 12 months. So you might want to rewrite them every 6 to 12 months. I think that's something people overlook is I need to have all these KPIs, or they just don't know what they are. So they do zero. Go to the middle ground with choose like 3.
Okay.
And I would say, look at the lagging indicators. So those are the ones that come after the fact that you want to look at. And those are really where the finance metrics come in, are your total revenue, your gross revenue, your gross profit, which is your revenue minus your cost of sale or cost of goods sold, and then your net income. And those are the three financial lagging indicators that I would start with. From a leading indicator perspective, it would depend on your sales, how your sales funnel works. So it would be, let's think email marketing is just an easy one to kind of have people, let's say you send 1,000 emails a month. Well, how many of those are getting clicked and opened and sold? That's what you would kind of want to look at for leading indicators. And then at some point you'll get sophisticated enough where you'll be able to predict those lagging indicators with the leading ones. My advice would be understand your business model, understand your sales cycle, and then set some simple ones and track them. The biggest thing is people just don't track them.
Yeah.
They don't take the time.
And I feel like there are platforms that, like, I feel like we're going to have, people listening to this that are on Shopify, for example. So they do have I think some ability to track that for you in their system. So get to know the platform that you're selling from, because that information might be available.
Yeah.
To you to track that information. Okay. That's super helpful. I know that's something that I didn't understand when I first launched my various businesses, and I didn't even know what a KPI was, even as a lawyer. And so, over the years, you learn these things, but I think that's something that a lot of people don't understand. So what would you say is the biggest mistake that you see founders or business owners make with regard to their finances or their financials? Just not tracking it, or is there something more specific than that?
You can go pretty far and not track your financials, but you can't recover from mismanagement of expenses. So the biggest mistake I see is that what I've just noticed after 35 clients and lots of other business P&Ls that I've viewed, is that people manage their business finances the same way they manage their personal finances, especially in their first business. And I do the same thing, and you can't get away from that. So whatever is ingrained in you in your personal finance will show up. And if you are a big spender in your personal life, you're going to be a big spender in your business, and it is not going to go well. So that's the biggest mistake, is just overspending, thinking you need fancy things when you don't. You don't. Wait till you have the cash to pay for the thing that you want, and set goals. Like I think, say, okay, I'm not going to buy this thing until I get $100,000 of revenue, or I'm not going to buy this thing until XYZ, or just not even thinking through what those how they're going to bring revenue in. I think that's a huge mistake people make, is they think, I feel like I'm building my business by doing an activity or by buying a thing, when in reality, they've never tied it to how it's going to generate revenue.
Right. It's, I feel like you have to constantly be thinking of what the return on investment will be for whatever you're spending money on. And if it's not revenue generation, you have to really think long and hard about whether it's something you should be spending money on, right?
Right. I think, I got this question the other day too. Is like, well, what about like security software and insurance? And I'm like, well, those generate revenue because they're protecting your revenue. So
right.
They're not actively out there selling you. That's not the issue, but they're protecting you from you want to save that revenue as much as possible. So the two metrics for success. I think I'll add one more thing is especially when people are starting out, is taking on debt is just, it's one thing to self-finance and say, okay, I'm going to put in this amount and I'm going to get to this point. But I've just talked to people recently. They're like, well, I had all this success, so now I should take on $50,000 or $100,000 of debt. And it's like, you don't actually have to do that. You already have a sustainable business sitting in front of you.
Right.
And I've seen that happen over and over again. And I think we just live in a culture of like, that's normal and it's totally fine. And it just gets people into a lot of trouble.
Do you find that that's also the case with investors, that people just think that that's what they're supposed to do, is go find investors, and they end up giving away maybe more of their company than they should have, when they could have probably, bootstrapped, like you're saying, from revenue and just operated in a lean way and not ever needed that investment money?
Absolutely. I think there's also, even to go a step further, there's just so many businesses that just don't need investor funding. They think that they have to have it, or that investor funding is the level of success. And that's not it at all.
Yeah. Like closing a seed round, and that means somehow you're successful.
Yeah, exactly. And so I mean, I've just seen so many, now I just can see it, and it's painful to like look at a P&L and be like, you have a profitable business sitting right in front of you and you were wasting it.
Yeah.
And that's hard. And so, I think fundraising when you're not ready or you don't need to, thinking it's the right thing to do, taking on debt when you don't need to, not fundraising, and then just, not thinking clearly about how you're spending your money.
Yeah. Okay. That is all gold. That's such good advice. Okay. So then, once a business is operating, how do you know if the business is healthy?
Yeah. Oh, I love this question. I'm pretty stoked about this. So I'm coming out with a free financial health assessment. It's really simple. Ooh. You plug in your 3 years of financials, and it kind of gives you an overview.
Oh my gosh.
Yeah. So
that's awesome.
I'll send it to you before you launch this episode, and you can put it in there, and people.
Okay. Yeah. Awesome. We'll share that link. That's very cool.
Yeah. And then this morning I actually went through with my insurance agent. He wanted like a little overview of how to know whether, businesses he were reviewing are healthy. And so we looked at a couple of different things. I think if you're we talked about stages of business. So let's just take, for example, you're operating, you're growing, you're not running off of investor money. So you should have some sort of positive net income. So I think the things that you would want to look at are your gross margin and how that is progressing over time. So it should be getting better over time. You should be getting a slightly more gross margin, and there will be dips, right? Because you will be, if you're building a product, you're going to start changing some of the packaging a little bit, and you're going to have some investment here and there. So you're going to see it go, I'm just making up numbers, but let's say you have 30% gross margin, it's going up to 35%. It might fluctuate a little bit, but over time, it's continuing to improve. So that's a super healthy business.
Okay. And that's true too. Like as you grow, you can, the MOQ, the minimum quantity requirements for whoever is manufacturing your goods. If you can order more, you're obviously getting things at a better price. So that also helps increase your gross margins.
Yeah, exactly. And then the next number we want to look at is your net income. And that's the revenue minus all your expenses over whatever period of time we're looking at. And that again, my personal preference is that people have like at least a 10% net income or a path to that.
Okay.
Whether they're there or not, depending on what phase of business they're in. I work with quite a few investor-backed companies that are in negative net incomes for a long time.
Yeah.
So we can come back to what that looks like. They're slightly different. But that to me is and that's usually over the course of 12 months, they have a positive net income. A lot of businesses fluctuate because of seasonality, that they'll have negative net income one quarter and a huge positive net income another quarter. But over a year, it's pretty even.
It evens out.
Yeah.
So people may be wondering, is net income the same as net profit?
Yes. I actually wrote in my Finance Fight Club blog,
Your blog is excellent, by the way.
Oh, thank you.
Wait, tell people what the blog is before we move into the difference between those two things.
It is called Finance Fight Club, and my goal with it is to have interesting content about finance that people can actually make strategic decisions using versus what's on Investopedia, which is boring and technical and
makes your eyes glaze over.
Yeah, half the time I'm like, I don't think that's right.
You're like, is that right though?
Yeah, so I love writing and it's been a great outlet, but I just wrote a blog about profitability and that profit is not real. There is actually no number on your P&L or balance sheet or cash flow that says how profitable you are. And it's really hard for people to grasp that. And it took me years to grasp it as a CFO because I just was like, where's the profit? Everyone talks about profit.
Yeah.
And so it's a combination of things. It depends on what stage your business is. It depends on what goals you have. It depends on owner pay, I think is a huge part of how healthy your business is. Depends on whether or not you want to sell and what it looks like to sell your business and who wants to buy it. And so the things that I look for a financial health are, you can look at EBITDA, which is earnings before depreciation.
If anybody ever watches, I feel like Mr. Wonderful talks about that on Shark Tank. I don't know if people know what that is, but maybe you want to really quickly explain what EBITDA is, because that's a really important number.
Yeah. So it's earnings before interest, taxes, depreciation, and amortization. And if you don't, I'm not going to get into all of those things, but it's basically like earnings where you take some things in and pull some things out to kind of make it look real. Depreciation and amortization are fake numbers on your P&L. They're kind of made up, so that's what it's pulling out. It's a good measure. It's what most investors want to look at and most buyers want to look at. The other one that I think is more accurate is free cash flows. It's very similar, but it trips people up because you have all these like things called tax shields, and it's like, why isn't a financial analyst just doing it for me? And really they should. It's a little bit more true. What it shows is how cash flows in your business. And so it's a little more accurate. The other one I really like is financial ratios. And there's a whole bunch of those, but there's your current ratio and your debt to asset ratio are pretty clear. So if you have a huge amount of debt and your assets can't cover your debt, that's a big red flag.
Right.
But the main one is cash. So how healthy is your business with cash? Are you able to pay all your bills every month? Are you paying yourself? Do you have cash reserves? If you're doing those things with cash, you're probably pretty healthy and low risk.
Okay.
It depends. Again, it depends on the stage of business. High growth startups are going to have a huge amount of cash, really negative net income.
Right.
Steady state businesses that have been around for 15 years are probably going to have a big cash reserve, maybe hold some inventory, a healthy amount, and then they're probably going to be looking at inventory health versus cash health, and they're going to have positive net income, and then they're going to be really closely playing with their gross margin because those are the levers they can pull in their business.
So if you are a product-based business and you have to continually be ordering inventory, how do you balance the need for, I know part of it is just demand, but I feel like one mistake product-based entrepreneurs make is they order too much inventory. And so what advice would you give a product-based entrepreneur about that?
It depends on what you're selling. So let's talk about food, for example. Food is hardest because you have expiration dates that you're up against.
Right.
And you have to get the product in the stores before whatever the limits are for their expiration date. So it has to go, I don't really know. I'm making this up, but it has to be in Albertsons before they have to have a year left before it gets in the store so that they can hold the inventory. That gets really complicated really fast because once you're up against those expiration dates, you got to liquidate inventory. So you have to really pay attention to that. So when it comes to inventory, it's very specific to your business, how you're
Mhm.
selling, how the churns are going, and
Mhm.
then you match it to that.
Okay.
And then with other types of products that can sit on the shelf for a long period of time, the challenges that you want to look at are, do you need to update the product?
Mhm.
You don't want to sit on something if you're going to update it every year. Like think of iPhones. You don't want
Yeah.
2 years of iPhone inventory, would do you no good. But
No
you
one
might,
wants it anymore.
right, but you might want, maybe I don't know what Apple does, but maybe they pre-order 6 months of inventory because they know they're
Right.
going to be able to sell out. And they
And the way
probably,
they know that is from their KPIs and having someone like you advising them.
exactly, right. So
Right.
it gets, I think product-based businesses, that piece is once you've got cash under control and all your expenses under control, it's just inventory management,
Mhm.
which
Mhm.
sounds it's the simplest part, but it's very complicated. And then you're
Yeah.
up against supply chain, and then you're up against, well, how do we expand? So
Mm.
it's a constant thing that you are measuring, and it changes over time.
I'm curious, if you have product-based clients that come in, do you ever, as a part of your service, actually help them determine strategically what their pricing should be?
Yes.
I mean, do you get into that with them?
I love pricing. Pricing is so fun. I do pricing analysis all the time. Here's my spiel on pricing if you want
Okay.
it.
Yeah.
It is way more art than science.
Yeah.
So what I provide is the limits. Don't go below this limit on your price. Here's all
Mm-hmm.
the discounts that you can build in. Here's your strategy. So if you want to be a premium brand, don't build in discounts. You don't want to discount your
Right.
products all the time.
Right. Right.
We want to talk. The only thing that you might want to talk about with discounts is like, do you need to liquidate inventory and therefore go to the TJ Maxx's and the
Mhm,
Ross's,
mhm.
and they're going to take a huge cut. Or we're going to like talk about
Yeah.
with Costco.
Right. Right.
Um,
Right.
so
Okay.
those are things where the limits come in.
Mhm.
Then it's a lot of research on your competitors,
Yeah.
what they're charging.
And do you do that as well?
Yes.
It's,
Yeah.
okay.
We kind of just pull the whole thing together and then advise. But what I think, my financial analyst said this beautifully once. She was like, I think people think you're magic. And I'm like, yeah, it's kind of true with pricing. It's a lot more magical
There's a
than
sweet spot that you're shooting
scientific.
for.
Yeah. Well, and then not only that, I can't predict what people are going to pay. We just have to test.
Yeah.
And that's,
Right.
I think the barrier is to people understanding pricing is I can put anything all day long into a spreadsheet and it can
Mhm.
help. But at the end of the day, people are going to
Yeah.
pay what they're going to pay, and they're not going
Right.
to pay what they're not going to pay. So you can ask for $10 for a piece of gum and you may never get it.
Exactly.
And so you have to pay such close attention to customer data. So what we do is set up those things for especially earlier companies that are like, I have no idea how to price.
Yeah.
In the later stage, they understand what their customers are willing to pay.
Right.
Then
And
we're
they have that trailing information to tell them what people have purchased.
yeah, and then we're
Yeah.
focusing a lot more on the gross margin. Like, okay, well, what
Yeah.
are the lowest amounts that you can pay? And then how do we get volume discounts?
So, and that is so helpful. It does help define your profit margins, right? So that's useful for as a product-based entrepreneur. I know you're always thinking in terms of, how do I stay within my margin, or how do I meet my margin, while I'm sourcing, the component pieces and the manufacturing and the distribution costs, packaging costs, advertising, all of that. And so the pricing is such a critical part of that, and understanding that and having a strategy for it. So that's awesome. Yeah, I feel like if you don't have it, the next thing you'll have to design is something where people can come to your website and plug in their information to be told your pricing is too low, or you need help with your pricing. You're going to go bankrupt.
Oh, that would be great. I know I should just start writing white papers on pricing. That would be
Yes.
fun. Yeah.
Yeah. That's awesome. That's okay. That's super interesting. Okay. So then what would you say are the keys to, so say somebody's launched and they're starting to make sales and they're now wanting to scale, like they really want to hit the accelerator. What are the keys to preparing to scale financially? What kinds of things do people need to understand?
I think the biggest one is what what does scaling mean for them? So what
Mm.
are the goals that means? Sometimes, and scaling can mean all sorts of different things. I think often, like I'm sure from you and our perspective, when we work with people and they say scaling, we immediately think venture-backed, PE-backed businesses that have $10 million sitting in the bank. You could just
Right.
be a steady state business that's just like ready for your next stage.
For growth, for
For some
expansion.
sort of growth. Yeah. My metric that I use is if you're growing more than 6% year over year in your gross revenue, you're scaling.
Okay, that's
And
helpful.
under that, I kind of think of as steady state. Now, I'm sure someone disagrees with me on that, but that's my view of like, that's pretty high growth. Not every business grows every year. Sometimes you contract a little bit and then you grow a lot the next year, and that's okay.
Right.
So that's one thing, is know your goals. And then the second is get organized. This is where if you don't have thing and tax in place, like you're going nowhere. So you get those in place, you get a fractional CFO, set the goals, you set those clear KPIs, and you keep building the KPIs. And then you start to optimize for revenue growth, where you're saying, okay, all these expenses, they're not driving revenue. We're going to cut them. We're going to do this. Then you optimize your team. You optimize your sales process. So one of the things that I do specifically with lots of customer or clients is review their sales teams and how efficient they're being. So if you're getting all these conversion rates, then you need 6 people on your sales team to meet your revenue.
Right.
3 you have, or you have 13 and you're only getting this. 5 of those people have to go, or they got to be trained better.
Or or they got to step up their game. And okay. All right. That's good. That's super helpful. And I appreciate the understanding for people listening that scaling does not necessarily mean that you are, a tech company that's venture backed or private equity backed and is about to, go international or something. Scaling, as you say, it's just a matter of growth.
Yeah.
At a certain percentage. Okay. Per year. Okay. So, on the other, so scaling, I think scaling is everybody's objective generally when you launch, unless you're just like a small mom and pop store or something, you don't have it, the intention to expand. But for product-based businesses in particular, scale, I think, has to be one of your goals.
You got to
get. I know people who are very happy just keeping it small, but the other goal aside from scaling could be getting acquired or selling.
Right.
So what are the keys to being prepared for a sale? And is it different than being prepared for scaling? What are the differences? Yeah.
I think they're overlapping, right? In some degree, in that from my perspective, from the finance perspective, is you have to be really clear on your value. And in order to be clear on your value, you have to have incredibly clean bookkeeping and like those have to be done. And so I think the biggest thing that I've noticed when people say, oh, I want to be in that track to get acquired, is they're ill prepared for how long that's going to take. It's going to take 2 to 5 years. Like you are just not going to wake up tomorrow and be like, I'm ready to sell my business and then get someone to you. That just never, I don't think it happens. It may happen. I know, like, venture-backed companies, that's their whole track is to get acquired at some, that 99% of them are trying to get acquired. So they're building the processes all the time. But if you're not one of them and you're thinking, well, at some point I want to sell, what you need to do today is understand what value you are today, which takes getting clean financials in place, getting clean KPIs, understanding your sales process.
Right.
And then you look at your value. What would someone purchase your business for today? And then what do you want to be purchased for? And then figure out what the gap is. And it's going to take you 2 years to correct that gap minimum.
Wow. Yeah.
I've also just heard many, many horror stories of books not being cleaned up before an acquisition. And so you have to go back and get audited, and that costs money. It's expensive.
And it can be a deal killer, right? In a big way.
Yeah. And then last, it's really just like if you're selling the product that your business sells, you have to know who's going to purchase you.
Right.
So I'm sure you run into this too with IP, is like, are they purchasing you for your IP or your trademark, or are they purchasing for a secret recipe that you have, or your brand presence? There's lots
of customer list, or
there's tons of reasons why people would purchase your business, and it's probably not what you owner are
Mm-hmm.
thinking you're going to sell.
Exactly. Yeah. Okay. That's super helpful. It is like IP is definitely, I talk about that a lot, um, with my clients, because if you don't have your intellectual property secured, identified, secured, protected properly, that is a deal killer, because that is what they're buying. I mean, generally by the time you're at a point where you are trying to sell, it's because you have an established brand.
Right.
And so it's very much tied to either your brand and branding, or your secret sauce, or proprietary, trade secrets, that's all intellectual property. So that really goes hand in hand with the financial. You have to have those things buttoned up and cleaned up, like you're saying, to be taken seriously. I feel like in the process, if you've got someone who's interested in buying, if you don't have those things in place, I think that's a major red flag for someone who's looking to purchase. Okay. So what steps can businesses take then to improve their financial? So say maybe they're not yet in a position to hire you, and they want to get there, but they're not there yet. So what strategies can they put in place now to begin improving their financials until they're able to hire someone like you?
Yeah, I mean, at the very least is build a calendar for financial review. So that means like block your calendar for half an hour every month, and sit down and look at the prior month financials. And like that, you're already like light years ahead of a lot of business owners if you're just taking the time to do that every month. So that's step one. The prequel to that is, if you don't have a bookkeeper, get a bookkeeper. I feel like that needs to go without saying, but it doesn't often.
No, it needs to be said.
File your outdated taxes if you haven't filed your taxes. I've talked to a bunch of people recently that have outdated taxes, and I'm always surprised by that. But
you're like, what?
So do those things. Those are really important things. But then, so set aside a time every month to review your financials, start creating budgets, build a budget and a forecast. Even if it's like, I don't care what tool you use. It doesn't matter. I think people get so bogged down with the tools. Like, get a notebook and just be like, what do I think October revenue is going to be? Write it down. It doesn't have to be sophisticated. It doesn't have to be Excel spreadsheet. So start with that, start creating budgets and working on a budget. If you are struggling with personal financials, get that in place. It'll help your business. It's not going to hurt your business. So those are all things you can start working on, and then you can build up the complexity there, where then you go to like, okay, 6 months from now, you've been reviewing your financials, you're set, you're in the routine, and then build your KPIs and start. Okay. I also think my big advice is these things take time. These habits take time. It's really hard to get in the rhythm of doing something once a month, because once a month in our brains is not every day.
Right. It's not building a habit.
Yeah. And so just start there. Or, if it helps, do weekly reviews. Log into your bank account every day.
Right.
If nothing else. Just don't forget to pay attention to it. Right.
Yeah, exactly. I think that's so critical, just to see what's coming and going, and the status of things. That's such good advice. I'm having visions of like all these products you could sell, or courses for people who are not quite ready to hire you yet.
I am going to do a forecasting retreat in November.
Oh, you are?
I am. Yeah.
Okay. We need info on that. That sounds amazing. Okay, cool. Well, so say somebody's doing this, at what point is it time, do you think, to hire a fractional CFO like you?
Yeah. So I've played around with this a lot, and I've learned from my own mistakes of offering client things when they're not ready. And I found $1 million in revenue is a good starting point to think about it. It's not always the right time. Some businesses you don't need it till 3 to 4 million in revenue.
Okay.
But I think if you are at all struggling with paying yourself, you're overwhelmed with your financials, you're ready for someone else to take over. I've met a lot of business owners that they're doing something not finance related, but they have a finance background and they're probably okay for a little while. But if you don't have a finance background and you're willing to kind of be coached and taught, you're probably ready for a CFO.
Okay. Yeah, that's, there's a lot of thought leaders out there who have said, you never want to be the smartest person in the room in your business. And also the things that are not your strength, you should definitely delegate to people who are really, really good at it. And so I think it's a good thing to think about doing probably sooner than later. Because like for me, I think, that's definitely, I'm just not like the finance person. I love the legal, but it would be better for me to have a partner in that, somebody that I can trust, that, understands my objectives and can sort of keep me on pace. I feel like so often though, we all kind of come from, I don't know if you deal with like the emotional or mental, like mindset side of it, but I feel when it comes to finances, there's a lot of shame. There's a lot of embarrassment. So how do you deal with that? Like, what do you say to people who maybe are feeling like, oh my God, I need help and I'm so embarrassed to let someone behind the curtain in my business because I have not been doing any of this. What would you say to them?
I mean, one, I've seen it all and there's no judgment,
Yeah.
no judgment whatsoever. Everyone has made every mistake in the book and you're no different than other people. And I don't mean that to just everybody those mistakes, and it's normal. And running a business is really hard. I run my own business. It's really hard.
Yeah.
I run clients' businesses and I see their struggle. So there's no shame. We just work on little things at a time.
Yeah.
And that's the big piece is it's small change over time. And I can't come in 1 month, make this massive difference.
Right.
But we can keep working on it. I have one of my favorite clients, and I shouldn't say that, but I have a favorite client, I have lots of favorite clients. I love them all. But one particular, we've been working together for a year and she is just now going to pay herself.
Wow. Yeah.
And
That's not unusual.
no, it's not. And
Yeah.
how she's going to pay herself? Pricing.
Wow. See, that's such an important conversation to have.
Exactly.
And she would not have figured that out without your help, I'm sure.
No, and it was little changes over time. We got all these things in place, and then it was time to be like, let's look at your pricing again. And that difference in pricing is what she's going to pay herself.
So for a client like that, how often do you meet with her?
She is an advisory client, not a fractional CFO client. So we met monthly for 6 months, and then now we do quarterly meetings.
Oh, okay.
But my fractional CFO clients, I meet with them every other week. I don't.
Oh, okay.
All of them, regardless of, and they can choose not to, but that's our structure.
Yeah. Okay. Awesome. So then the next question would be, and this is a depends. I suspect there's like no hard answer for this, but what should a business owner budget, for monthly financial support like what you provide?
Yeah. So if you're a bigger company and you're thinking, okay, I need a fractional CFO, I like to think of it as a full-time CFO is going to be $250,000 a year salary plus benefits. That should equal out maybe 1% of your revenue. So if you're a $20 million business, you maybe are almost ready to hire a full-time.
Ready for that.
Depending on the complexity. There's lots of businesses that go much later than that or need one much sooner.
Okay.
And so I would budget just 1% of your revenue on financial services. Now, again, if you're early stage, it's going to be way more than your revenue.
Yeah, just because you don't have a lot of revenue yet.
Great. But that's a general rule. So if you think of 1% of your revenue and you're over the $1 million mark, you're kind of close to what you might be spending on all of your financial services.
Right. Okay. That's super helpful. Okay, awesome. So this has just been amazing. I mean, we're getting close to almost an hour of conversation. I feel like I could talk to you for another 2 hours about this and just pick your brain. But I'm so thrilled to know that you're out there and you're such a wealth of information. People definitely, I encourage you guys to subscribe to her Finance Fight Club blog. It's excellent. And now I love that people can go do this assessment on your website. You're going to share a link with that to kind of get a sense for how healthy your business is. And so this has just been so useful. I will share the link to your main website as well for people so that they can reach out to you. And I hope we can talk again. Like, this is just such a meaty conversation. I feel like there's so much we could cover, but hopefully this has given people like a really good framework and a good starting point, at least to know what questions to ask and what issues to explore for themselves. So Natalie, thank you so much for joining us today. You're just awesome. And I'm excited to see how many people reach out to you, because I think you're going to get some interest based on what we're talking about. Because this is, like, for me, I want to just hand this over to somebody else. So I'm sure there are a lot of people that feel that way. So they'll be, not that you can fully wash your hands of it, but just to have somebody like you in their corner to, to help them navigate this stuff, I think is such a gift. So anyways, so thank you so much for joining us today. And we will see you next time. And everyone else, look for the links below so you can reach Natalie and you can subscribe to her blog. And I'll see you guys on the next episode. Take care.
Thanks.
This has been the Beautiful Brand Podcast with Jessica Eves Matthews. Make sure to subscribe so you don't miss an episode. And if you have a specific topic you would like Jessica to cover, feel free to email us at podcast@jessicaevesmatthews.com. See you next week.